More than 11,200 Americans will turn 65 every day from now through 2027. And as people head into retirement, generating reliable dividend income is a big concern. We'll tell you about ETFs that could be a good fit for income seekers. Plus, we'll tell you the strategy behind a top performing commodity ETF with a 5-star Morningstar rating. Stick around for that. I'm Thalia Hayden with ETF Guide. It's great to see you again. Before we go any further, just a quick reminder that Spotlight is available on major video streaming platforms, and we're pleased to announce that Apple TV has just been added. Just download the ETF Guide app on Apple TV to watch. Plus, you can still find us on Amazon Fire TV and Roku, along with major podcasting platforms like iTunes and Spotify. Investors face many challenges, including keeping up with inflation, positioning for important megatrends like electrification, and generating reliable dividend income. So here to discuss that and more is John Love, CEO at USCF Investments. Hi, John. Welcome to the show.
Hi, Thalia. Thanks for having me.
Good to see you. Well, the U.S. Consumer Price Index has been easing over the past few months. And while certain commodities have declined in value, others have seen their prices stay firm. So how is inflation impacting commodity prices?
Well, commodities are a big part of what drives inflation. They're foundational, the foundational input to the value chain. Broad commodities as a group, more than any single commodity, have a high correlation to inflation. Historically, they've been a great inflation hedge. So you saw what you would expect in this past inflation cycle, broad commodities kind of rising hand in hand with inflation as it went up. But it's worth noting, as you mentioned, that not all commodities are the same. Some commodities drove that higher. In this cycle, it was energy and some of the industrial metals, but other things we're either flat or even a few things down. But again, broad commodities as a group, that is something that's just at the base of that value chain. And it's worth pointing out more recently what we're seeing is that while inflation has come down, commodities have not fallen nearly as much as overall inflation since it peaked in 2022. I think a lot of people expect that to happen. And indeed, commodities did come down a bit as inflation turned over. But inflation, we're not having deflation or disinflation, I should say. So as a group, commodities are still higher than they were when this inflation cycle started. And in fact, our broad commodity funds are almost as high as they were when inflation peaked. They fell a bit when it turned over, but they started rising again. And they're holding out really well in terms of, just broad commodities in general, where some strategies are just kind of holding up. We've actually seen some good performance.
Wonderful. Well, the USCF Summer Haven Dynamic Commodity Strategy No K1 Fund, that's an excellent way for investors to obtain core diversified exposure to commodities. Not only has SDCI outperformed its commodity ETF peers over the past 1, 3, 5 years, SDCI has also achieved an impressive 5-star rating from Morningstar. What does the fund do and what type of investors might it appeal to?
Well, in terms of who should it appeal to, it's designed to be a core holding. So it should appeal to the investors that are looking to build a long-term diversified strategic allocation. The diversification is critical, as we saw in 2022 when stocks and bonds were way down and commodities were way up. And then what it does in short is SDCI gives investors exposure to broad commodity beta, but it doesn't hold the entire universe blindly all the time. Instead, it uses a rules-based system that dynamically allocates to commodities that we think are more likely to outperform. Putting that in other terms, SDCI aims to systematically pick the winners. And just as important, we're trying to avoid the losers. We mentioned earlier, not all commodities are the same. In fact, they can be very different. You look at the S&P 500 and your average any two stocks, they move together in tandem almost all the time. That's not true in commodities. Cocoa and cotton, crude oil, copper, these all have different drivers. So one could be doing one thing and something can be doing something else. And that's something that we can take advantage of. And that's what we attempt to do with SDCI. One thing I'll point out, people tend to focus on headline grabbing commodities like crude oil. And that's what most funds and indexes hold a lot of. But good commodity performance can come from anywhere. Crude oil is probably the most important commodity to the global economy, but it doesn't have a corner on opportunity. For example, right now, the big story is cocoa. It's setting records that it hasn't set since it's at a level it hasn't been since the 1970s. A year and a half ago, it was about $2,200. It's started this year at 4,000. It rocketed up to 6,000 this week. And you look at that and you think, well, who wouldn't want that in their commodity allocation right now? Most traditional indexes and funds have almost a zero weight, if not a zero weight, to cocoa. SDCI has a 7% allocation. So that's how we're different. We can provide exposure to things that are sometimes overlooked, but still has just as much opportunity as the headline grabbers. And when that story changes, we can be dynamic and change it again. So to sum it up, we aim to be, give you that broad allocation to the asset class, and yet do it in a way we think is better.
That makes sense. And as the global economy undergoes electrification, the infrastructure necessary to produce and store energy will require substantial amounts of certain metals. Now, the USCF Sustainable Battery Metals Strategy Fund and the USCF Sustainable Commodities Strategy Fund are both uniquely positioned to capitalize on this trend. Can you tell us more about that?
Yeah, absolutely. So we're always trying to look ahead and look ahead to the future. Our tickers start with Z, the last letter of the alphabet, where we're looking to lead into a new era of commodity investing. And the idea behind these is kind of two things. One, as you just mentioned, we're trying to take advantage of things like electrification. Commodity markets evolve. They're the oldest asset class, but the principal commodities change over time. Just for example, energy. Our energy commodity used to be wood, and then it was coal, and then it was fossil fuels, and we're moving towards solar and electric. And we want to be keeping up with that and giving investors exposure to those things. So we kind of have a barbell where we have your traditional commodity baskets and things like SDCI, and we have these baskets in ZSB and ZSC that are giving you exposure to what we think is a big story. It has its ups and downs. I mean, right now there's a lot of headlines about, oversaturation of EVs and investors pushing back against that. But I think what that really means is investors aren't against EVs. They're worried about where am I going to charge? Is there going to be enough charging? These kinds of things. And I think ultimately what that means is more demand for these metals, because the same metals are needed to build power stations and batteries and charging infrastructure and transmission. So that's a big bullish thing. The second thing we're doing with that barbell is we're giving investors a choice. Some people don't want fossil fuels in their portfolio. We don't actually directly own fossil fuels in SDCI or something like that. We own futures contracts, which are ones and zeros at an exchange. But nevertheless, the argument there is nuanced. And for people that understand that, or they just don't want to have the headline of fossil fuels in their portfolios, or they want to be exposed to those commodities that they think are doing something good for the planet, that are weighted in a way that takes into account carbon emissions. That's something we're offering right there. So we're trying to give you, the best of both worlds, look to the future, and let investors allocate as they see best.
Got it. And one final question before you go. According to estimates from the Retirement Income Institute at the Alliance for Lifetime Income, more than 11,200 Americans will turn 65 every day. That's over 4.1 million every year from now through 2027. So as people head into retirement, generating reliable dividend income, it's a big concern. And your firm offers a few solutions, including the USCF Midstream Energy Income Fund and the USCF Dividend Income Fund. How did these ETFs work, and how might they help retirement income seekers?
Yeah, well, that's a lot of retirees, and it's definitely. I mean, when you're facing long retirement, like many of us will be, living longer, it's a real challenge. And so, what we're offering with these two products is what the manager we work with, Miller Howard, calls unfixed income. And the idea there is fixed income gives you, people seek that out for stability, and you get stability, and that's good and bad. The bad side of it is your cost of living over, say, 15 years, 20 years could double. And yet your portfolio, while it might turn out the same yield if you've locked in a long-term fixed income yield, the dollar amount is also fixed on that initial portfolio amount. So it's not growing. And suddenly you've got half the portfolio, half the income you need to keep up with your spending. So what the idea here is, let's look at let's broaden out and diversify and look at other sources of income that can actually grow dividends. So, looking at equities and MLPs in UDI and UMI gives investors the opportunity to actually participate in companies that are growing their revenues, growing their dividends. So, the rate, even if the rate doesn't increase, the dollar amount of what's coming in may increase over time, and you get growth and kind of protection that way beyond something you get with just plain fixed income. UDI is looking at quality companies that we think over time, hopefully will do exactly that. They'll have reliable dividends and hopefully growth over time. And UMI is in MLPs, and it's a great time for MLPs right now. Their PE ratios are fairly low compared to the broad market, and their balance sheets are good. Not all of them. UMI and UDI, they're both actively managed, so they can screen out the things that a passive index fund might have to own. We don't have to own that. We can look for higher quality companies and try to constantly get investors those growing streams of income that'll complement their portfolios.
Very insightful. Thanks, John, so much for joining us today, and keep up the good work.
Thank you very much. Thanks for having me.
And that'll do it for us today on the episode of Spotlight. If you enjoyed the show, tell us in the comment section below by hitting that like button. And to learn more about the investment strategies and ETFs we discussed on today's program, be sure to visit USCFinvestments.com. I'm Thalia Hayden with ETF Guide. Thanks for watching, and we'll see you next time.